Let's get to those top picks. Andrew's first idea is TCON Residential.
Yes, we talked about being defensive, and I think this is one great way to play it. TCON focuses on the single-family rental home sector in the United States. This is a very defensive asset class. If you think about it, they focus on the cohort between 35 and 44 years of age. These are people that need homes, yet given home affordability today, are priced out of buying homes. This cohort is going to double, their growth is going to be double that of the broader population over the next 5 years. So they need somewhere to live. They can't buy a home. They can now rent a home at a cost that's 36% lower than the average condo. And so when you look at that backdrop on a supply and demand basis, and then you think about defensively, they have the highest mark-to-market, meaning they have a 20% gap in terms of their in-place rents and market rents. That's a great thing to have in this type of market. Yet the stock trades at a 30% discount to its market value. And if you think intuitively, they own a portfolio of homes. In theory, you could go off one by one and sell off all these homes. Of course, as a portfolio, you could actually get more because institutions have really gravitated to the sector. So we think it's a very cheap stock with great earnings growth and a great management team.
Okay, your next idea, First Capital REIT.
So an extension of the defensive theme, First Capital owns the best grocery-anchored shopping center portfolio in North America, probably globally. This is a very defensive asset class when you have 85% of your tenants as necessity-based retailers, whether it's grocery stores, drug stores, et cetera. What's so surprising to us, given they have the best portfolio, they've been the biggest laggard amongst their peers. If you look over the past 5 years, their peers are up 35%. First Capital, the stock, is down 12%. Yet they've generated great returns in terms of earnings, in terms of what they can do on new leases, et cetera. The IFRS values north of $24 and the stock is below 15. That is a really wide gap, and I think something structurally needs to be done here, just given how cheap it is. You're starting to see the company act on that, selling assets in order to close that gap and buy back shares. And I think more eyes are going to be on this because when you have such a great quality portfolio trading at such a discount to net asset value, typically something has to give. And we think the risk reward is definitely to the upside here.
And then finally, Summit Industrial Income REIT.
For us, this is the best way to play industrial warehouse in Canada. Simply put, their main focus is Toronto and Montreal. Those are the best markets in North America, where you're seeing rents increase 35% and 60% between Toronto and Montreal, respectively. That's huge. And so they're already sitting on a very big mark-to-market. They're seeing leasing spreads at double what, when leases come up, they're signing leases at double the expiring rate. It trades at a 33% discount to NAV. If I had to pick a name for M&A activity in industrial, this would be the one. They've done it in the past with their first iteration of Summit back in the 2000s, and I see no reason why they wouldn't want to do it again. And we think it's a great company, irrespective of M&A. You will have great earnings growth out of this vehicle.
And what about distribution growth? Have they been consistent in that area?
Yep. What we like is that it's a lower yield, about 3.5%. What you typically like to see is REITs retain their cash flow, particularly in this type of environment, because they can use that cash for accretive activities, whether it's reinvesting in their properties, buying new properties, or frankly, buying back their stock. That's probably the most attractive thing they can do today. So we like the idea of having a low yield. And then to your point, they have the room to increase it every year.
Yeah, it's interesting though, isn't it? The unit's down about 29% this year, worse than the broad market.
And that's the opportunity. We have so much capital sitting on the sidelines waiting to invest in publicly traded real estate. You have the Blackstones and Brookfields of the world that have raised these large private REITs with tons of capital. They're just waiting for the all clear sign in terms of credit markets and capital markets. And when they do, this is the quickest way to buy portfolios, i.e. buying public companies that trade at discounts. And that's stunning to us, where you have these small periods of time where there's big dislocation in the public markets. In my career, I've always seen them turn into the best opportunities.